Good morning. This is Professor Marsh again, and I'd like to review the homework for Chapter 4, which is also Unit 4. This was in your book, and let's go ahead and take a look at exercise set A. So get your book out and or put it on your computer. It's probably, you can listen to me while you read the book. The first assigned exercise in exercise set A was number 1, which is to identify whether each of the following transactions, which are related to revenue recognition, are accrual, deferral, or neither. And the first transaction is sold goods to customers on credit. Well, we know at this point that if we were using a cash method of accounting, we would not record that sale. But what method of accounting do we record that sale under? Well, it's the accrual method. That's right. This is the classic example of accrual-based accounting, where you record the sale at the time that you provide the goods or services, even if the asset entry for that sale, the offsetting entry to the revenue credit, is going to be a debit to accounts receivable. So that's A is accrual. Now B is the reversal of an accrual. So it's not an accrual, it's where you actually collect the cash. And so at this point you're offsetting the account payable that you accrued on A, and now you're collecting the cash and reducing accounts payable. So that's just a transaction where you're cleaning up the asset side, replacing one current asset with another, a debit to cash and a credit to the prior accounts receivable. Okay, C, sold goods to customers for cash. Well, guess what? This is not an accrual. This is going to be treated as a sale, whether you use a cash method of accounting or an accrual method of accounting. So C is an example of a transaction that would be booked as revenue. It would book, meaning it would be recognized as revenue, whether you were using either method of accounting, whether you were either cash or accrual. And then D, collected cash in advance of for goods to be delivered later. Well, under a cash method of accounting, you would recognize that income, but since we're learning accrual-based accounting, we know that when we collect cash but we haven't performed the service or delivered the goods, at that point what we do is we defer the income. So this is the classic example of a deferral transaction, in which when you collect the cash, you debit the cash asset, but then you set up an unearned revenue or deferred revenue account, and that's a liability account. It's a credit entry because you've collected the cash but you haven't earned the revenue yet. So that is number 1. Let's go on to number 2. Oh wait, not number 2, number 3. Identify which type of adjustment is indicated by these transactions. Choose accrued revenue, accrued expense, deferred revenue, or deferred expense. Okay. Rent paid in advance for the use of property. So what is that? What is that? That is it accrued revenue? No, unless you're the landlord, right? If you're the landlord, it would be accrued revenue. What if you're the tenant, though? This says rent paid in advance. So the it looks like the author is doing this from the perspective of the tenant. And so rent paid in advance for the use of property. Do you book the expense now? Let's say you pay 6 months rent in advance. Do you book it all now, right away, when you pay it? No. You set it up as an asset. You set up a deferred expense, which is a prepaid expense on most charts of accounts. So prepaid expenses, that is an asset, and then as the lease expires month by month, then you recognize the rent expense as the months expire under the term of the lease. So that would be a deferred expense or prepaid expense. That's A. Okay, let's look at B for exercise set 3. Exercise set A, problem 3. Cash received in advance for future services. So what is that? Well, cash received in advance for future services is deferred revenue. Okay, that's going to be our liability account. So the entry to record that would be to record the increase in the cash asset. That's a debit. And then we would book an offsetting credit to the deferred revenue liability account, which is the short-term liability account, and not a current liability account. Okay. Supplies inventory purchased. So supplies inventory purchased, well, what happens there? You either purchase them on cash or credit, it doesn't matter. So either you set up, either you pay cash, which is a credit entry, or you incur an account payable. And then the supplies inventory that you receive goes into an asset account. Okay, and why do you not just expense the supplies? Well, possibly if you were a cash basis accounting system, cash basis taxpayer, you would go ahead and take that expense. But since you're using accrual accounting, you're going to go ahead and set that up as a prepaid expense. So it's a deferred expense. Okay, it actually goes into an inventory account to be used as the supplies are consumed during the accounting period. You get to the ending accounting period, you figure out how many supplies you have left in the supplies account, and then you make an adjusting entry at the end of the period, which is what we're going to do later on in this chapter. Okay, fees earned but not yet collected. Okay, so fees are earned but not yet collected. That is accrued revenue. Okay, that's basically example A from exercise number 1 up above. It's fees that are earned. You've earned it, but you haven't collected it yet, so you go ahead and book the revenue. That's the credit entry, and then you have an account receivable. Okay, so that is number 3. It looks like we did 1, 3, 5, 7, 9, 11, and 13. So let's go on to number 5. And we see that this is supposed to be learning objective 4.2 and 4.3. So we're discussing the adjustment process and illustrating common types of adjusting entries, and then we're recording and posting them. Let's see if I have an example here. I do. As a matter of fact, I actually did this assignment, and you can see how I did it. And I'm going to hold it up to the camera and just let you see what my answer looks like, and hopefully it will look like your answer. So I booked 2 parts to this entry. Let's see, what did I do? Okay, I booked 2 entries here. I actually did more than the problem requires me to do, because I wanted to show you how this would be set up. So when you purchased the insurance policy on August 1st, you paid the $6,000 premium, and it was for 1 year. And so it sure is a good thing that the premium was $6,000, because we know that the premium is going to also equate nicely to $500 per month. So August 1st, by the time you get to December, you're going to have August, September, October, November, December. You're going to have 5 months of insurance coverage from that policy. So you will have used $2,500 of that $6,000 annual premium. So here's what I did. Is back on August 1st, I set up the asset of the prepaid insurance for $6,000, and I showed the credit to cash of $6,000, and I showed my explanation in my journal entry. And then actually the answer to your question is down here, the December 31st adjusting journal entry. And you can see this right here. It's got an AJE. That's how we typically do adjusting journal entries. We book the insurance expense, which is a debit, right? It goes on the income statement. And then we reduce prepaid insurance by crediting the asset of prepaid insurance by $2,500. And that's our year-end adjusting entry for that particular transaction. Okay? All right. Very good. Very good. So anyhow, let's look at number 7. Exercise set A, number 7. And in this one, reviewing the payroll records indicates that employee salaries that are due to be paid on January 3rd include $35.75 in wages for the last week of December. So this is the classic case of accrued expense for payroll expenses, wages payable. And there was no previous balance in salaries payable. Okay, they call it salaries payable, not wages payable. That's fine. At the time, based on the information provided, make the December 31st adjusting journal entry to bring the balance to current. So what are you doing here? You're setting up a liability account. You're accruing an expense. So you're going to, even though you haven't paid the wages, you know that you owe them for the period that ends in December 31st. And so you go ahead and you debit in your adjusting journal entry. So here at the top of the page is the adjusted journal entry. And you can see that you've got an expense that you're accruing of $35.75 for salaries payable, for salary expense, and then you're also booking an offsetting liability. The credit entry goes to salaries payable for the same amount, and that's your year-end adjusting entry so that you accrue the proper amount of expenses for salaries. Okay, number 9. Number 9. Prepare the journal entry to record the following business transactions, and you're purchasing supplies in January to be used during the year. So as you purchase the supplies, you pay cash. You're booking an asset, the supplies asset account for $38.50, and then you have an offsetting entry to cash to show that you paid cash for it for $38.50. And that's to record the purchase of supplies. And then at December 31st, you check the supplies, you do a physical count, inventory. You take the inventory is how we refer to it. At December 31st, you see that you have $800 left in supplies. And so at that point, you book your adjusting journal entry. And oh my goodness, I did not put an AJA next to this. So okay, so here you can see the adjusting journal entry is to take the expense for supplies. So supplies expense for $3,050, and that's the difference between what you had on the books and what's left at the end of the year in the asset account. And so then you credit the asset account by that same amount, $3,050. And what will happen is then on your books at the end of the year, you'll show the $800 that's left in supplies as the remaining asset in that account. Then on exercise 11, you can see that there are other adjusting journal entries for depreciation, rent, and the remaining balance of unearned revenue. So you're having to book the accumulated depreciation for the year, which you've calculated as $8,500. And on that entry, you're booking an expense, that's the debit for A, for depreciation expense, and then you have an offsetting credit for $8,500 for accumulated depreciation. So you don't, what'll happen is after you make that entry, the fixed assets will still be $120,000 and accumulated depreciation will be $32,500 when it's got the additional $8,500 of depreciation for the year. And you can see that as A right there. That's the entry right there. Sorry it's so compressed with my crummy handwriting, but you can see how I did that. And then the next entry, the unexpired prepaid rent, well, that's just calculating how much is left to go on the lease. You paid $18,000 in advance as rent, and you've got $12,500 left. And so you used up $5,500 as rent expense. And to reduce the prepaid rent, you're going to have to make a credit entry, because the prepaid rent is an asset, it's a debit. And so then you'll have rent expense as the debit. It'll go on the income statement for $5,500, and then prepaid rent is reduced by $5,500, which will get us down to the $12,500. And you can see that as transaction B right there. And then unearned revenue, you're told that the remaining balance of the unearned revenue at year end is only $555, and you had $3,500 that you were carrying on your balance sheet. And so the entry to book that revenue that you've now earned is going to be a credit entry to revenue. So you have to have an offsetting debit to unearned revenue, which is a liability, as we know. See, it's got a credit balance, which is the normal balance on your unadjusted trial balance. And so you have to make an entry for $2,945 to reduce the liability and book the revenue that you've earned. So at this point, this is what you do. Okay, and you can see that entry right here under C, where you've got a debit to unearned revenue, reducing the liability account by $2,945, and then you're recognizing revenue at year end by $2,945, and that goes on the income statement. So there you go with that entry. And let's see what we have next. I think what I did is on this one, let's see here. Prepare an adjusted trial balance from the following account information, considering the adjustment data provided. Assume accounts have normal balances. Well, let's just get out a journal page. Okay, remember, make your own journal pages. I've done this. This is a photocopy of the one I used for the last example. And so we've gotten to the end of the month, the end of the period, and we have to make some adjusting journal entries, and let's see what we have here. So salaries due to administrative employees but unpaid at the period end for 2000. Okay, so we're going to have, this is an adjusting journal entry, and salaries expense will be the debit entry. Salaries expense. You can do it along with me if you want to. You can go ahead and get out your, see if you can figure out how to make this adjusting journal entry at the end of the period. So salaries expense of 2000. I'm going to put that into the debit column, and then I'm going to make an entry for salaries payable, since we expect to pay them very shortly after the beginning of the next period for 2000. Oh, and you can see that I've done it in pen, which is a big problem here. I don't know why I did it in pen. I should be using my sharp pencil, but it seems like my pencil is getting duller and duller. But I'm going to say that this is to record salaries payable at year end, or at period end. And so I'll have that description down there. And that's the end of that entry. So we'll just put a line underneath it to show that that entry is completed. Now that's one of our adjusting journal entries. It looks like we've got another one also for insurance that's still unexpired at the end of the period. And let's see here. Do we have prepaid insurance on the books? Well, yes, we do. Look at that. We've got prepaid insurance on the books. And so it looks like our prepaid insurance on our unadjusted trial balance was $16,000, but now we know that at the end of the period, the insurance that's unexpired is still $12,000. So the difference between those two numbers, okay, the asset we already had on the books that we booked when we bought the insurance policy, and the value of the asset that's worth less because part of the term of the insurance has expired, we have to book that as an expense as of the end of the period. So what we're going to do is we're going to have, let's say that was adjusted journal entry number 1. I'm now using my sharp pencil. Adjusted journal entry number 2 is going to be a debit to insurance expense, and the amount of that debit is going to be $4,000. Why not $12,000? Well, because we already had the asset on the books at $16,000, and we have to reduce it at the end of the period to $12,000. So the difference is $4,000. That's the amount of insurance we've used during the period, and we're going to book that as an expense. And then we're going to make the credit entry to reduce the asset of prepaid insurance, and that credit entry will be $4,000. And what are we going to say is the description for this? To adjust prepaid insurance at year end. Okay, and so that's our second entry. Okay, so this isn't rocket science. This is just something you have to practice it. A lot of you in your homework didn't get this right because you didn't know how to do it. You've never done it before. A lot of you got full credit on your homework because you did a good job in trying to make these entries. But even if you got a 5 or even if you got a 4, you still need to practice this and to make sure that you understand this homework and can do it yourself. So that's a very important thing for you to do. So I am, let's see, going to, at this point, let's see what the rest of the homework is. Adjusting trial balance. Okay, so it says prepare an adjusted trial balance from the information. Okay, so I did that, and I did it in a kind of a condensed form, but because there's, let's see, we got these two. Let's see what we have here. 1, 2, 3, 4, 5, 6, 7. 7 accounts. Cash. Accounts receivable. Make sure I'm doing the correct problem here. I want to make sure that my notes here are for problem 13 and not for some other problem. It looks like I did. Let me go ahead and put this on the board for you. So I'll do it over here. Hopefully you can see what I'm doing. I'll bring the camera over in case you can't see it. So don't give up, okay? So I'm going to do the adjusted trial balance. Now, how do we do an adjusted trial balance? Well, what we do is we have 2 columns, right? We have debits and we have credits. Okay, so what is our first account that we're going to list on the adjusted trial balance. It's going to be the first asset account that we have on our balance sheet. Remember, we're going to go the 100s, 200s, 300s, 400s, 500s. So in the 100s, those are the assets, and the first asset that we always list is cash. So let's list cash. And cash is a debit, and it's $44,800. Okay. Then we're going to find the next asset that we would list, and that's going to be another short-term asset, and typically that's going to be accounts receivable. And we see that we have a $17,100 balance in accounts receivable. And we haven't adjusted that, so $17,100. Okay, now prepaid insurance. Now on the unadjusted trial balance, it was $16,000. And remember, prepaid insurance is another short term. It's a current asset. But we had an adjusting journal entry that had to reduce the prepaid insurance from $16,000 down to $12,000 at the end of the period. So prepaid insurance is $12,000 after the $4,000 adjustment. Now you maybe had to do some T accounts in order to do this. I mean, we did the journal entries just a minute ago, but let's go ahead and finish this. So let's see. So then after prepaid insurance, it looks like our next account is accounts payable. So accounts payable is a credit entry. Accounts payable is a liability, and on the unadjusted balance, it was $11,700, and it still is $11,700. There were no adjustments to it at period end. Then we have our salaries payable. That was a new account that we set up with one of our adjusting journal entries. So we set that up, salaries payable. And how much were the salaries that were payable? They were $2,000. So when we set that up, we had to go ahead and do the journal entry and then book a T account for salaries payable, which we now have as part of our entries in our adjusted trial balance. Then what's our next credit entry? Well, it looks like accounts payable and salaries payable are our only liabilities, so we have to go on to common stock. So common stock was, let's see, $30,000. I hope I'm reading. I've got very bad handwriting when I did this. Yep, 30,000. And let's see, what else do we have here? Do we have any retained earnings? No, no retained earnings at this point. Okay, very well. So our next entry is service revenue. And for those of you who've already done Chapter 5, remember, this is just the adjusted trial balance. This is not the closing trial balance. Okay, so this is the adjusted trial balance that we're going to use to prepare our financial statements, the income statement, and the balance sheet. But it's not the post-closing adjustments. The closing adjustments are not yet done yet. So we have service revenue on here. We still have our revenue and expenses accounts on the trial balance. And service revenue, wow, was $91,000. Pretty good period there. Okay, so $91,000. We didn't make any adjustments to revenue, but we did make some adjustments to expenses. And let's see, so we had, what else do we have here? Administrative expenses. Okay, so now we have to do our expense account. So these are our 100s, okay? These are our 200s. This was our 300. This is our 400s on the chart of accounts. And now we'll do the 500s, okay? And we've got administrative expenses of I hope I'm leaving enough room here. Administrative expenses of $54,800. And then we have the expenses that we booked as part of the adjusting entries. We have salaries expense of $2,000, and we have insurance expense of $4,000. Remember, these two expenses came from our adjusting entries. Okay, we had to set up expense categories. They're not on the unadjusted trial balance, but they do show up. This is the adjusted trial balance. Adjusted trial balance for whatever the XYZ company, whatever the name of the company is, and then you would also have as of end of period. So that would be your title that would be centered up above the adjusted trial balance. And then down here, you have to make sure it balances. And several of you who did your homework, you did adjusted trial balances and you didn't add them up to make sure they balanced. And when you add them all up, you get $134,700. And I think that's correct. And that's what I got on this side too, $134,700. So that's how you do the adjusted trial balance. Isn't that fun? Okay. Let's see. Then we had some problems in problem set A. So I'll just leave that up for a second. I promised to make sure you could all see this. So I'm going to take the camera over here and let you take a look at that, so that if you need to stop and take a look and check this against your own work, you can do that. But that is our adjusted trial balance from exercise set A, problem 13. Okay, if you can do that, you can do the work in this chapter. Okay, that was a good one to teach you the materials. Now let's look at problem set 1. Okay, so problem set A, question number 1. Identify whether each of the following transactions which are related to revenue recognition are accrual, deferral, or neither. Oh, so that again. Okay. Earn now, collect it now. Neither. Okay. You don't have to accrue or defer. The tax treatment for cash or accrual accounting is exactly the same. You earn now, you collect now. And that's the best way to do business, by the way, too. Get your customers to pay when you deliver the goods or services, unless you're in a specialized business where the custom is to not collect now. But when we provide a legal service for our clients, we like to collect when we provide the service. When we deliver the documents or end the case, end the matter, we like to go ahead and get paid at that time. But you're learning accounting, not entrepreneurship. So, okay, so A is neither. Earn now, collect later. Okay, well that's an accrual, right? That's an accrual. Sell on credit. Okay, that's an accrual. Earn later, collect now. That's a deferral from revenue recognition, right? You collect the money now, but you're going to earn it later. Okay, so you have unearned revenue, and you set that up as a liability, even though you put the cash in the bank. Okay, let's look at number 5. That was the next one. So indicate what impact the following adjustments have on the accounting equation: assets minus liabilities, assets equal liabilities plus equity, and assume normal balances. Okay, so we're looking at the adjusting entries, and we're trying to see what the impacts are. So unearned fees adjusted from 7,000 down to 5,000. Well, the first impact on that is that you are reducing that liability. Okay, so the debit entry is going to go to unearned revenue or deferred revenue. And then the second impact is going to be that you have additional revenue, so the credit entry will go to fee income. That's A. B, you recorded depreciation expense of $12,000. Okay, so the first impact of that is that you have an expense that you have now recognized, accrued, of $12,000 for the period, and then the other expense is that it's going to go into the accumulated depreciation account, which is a contra account on the asset side of your balance sheet, and so that's going to reduce your equity by $12,000, and of course reduce the amount of your assets by $12,000. Okay, C, prepaid insurance is adjusted from $18,500 to $6,300. Well, all right, so you have an asset on the books called prepaid insurance, and you're reducing it by $12,200 for the period. So what happens here? Well, you're recognizing insurance expense for the period in which you use that insurance, and that's $12,200 as a debit entry to insurance expense, which is going to reduce your equity, and then you're also going to reduce the asset by $12,200. Okay, so as you can see, assets, for every asset adjustment we have either an adjustment to another asset, or we have an adjustment to liabilities and equity that offset it. And for every adjustment to liabilities, we have an adjustment to assets or equity, or perhaps another liability. But in any event, it preserves. You preserve the equality of the accounting equation, and that should be the point of this. Okay, so supplies balance is $500, but you do the physical count at the end of the period and you find you only have $220 of supplies left. So the difference is $280 in supplies that you have used during the period. So you book that expense. That's your debit entry to supplies expense. That's going to reduce the supplies asset and also reduce the equity. So you'll have a debit entry to supplies expense that reduces equity, and for $280, and then you also reduce the asset by $280 for how much you've used in supplies. Okay, enough on that. Okay, number 9. Let's see, the T accounts to make the 1231 adjusting journal entries. And so as you can see, you're looking at the T account balances in your general ledger, and you can see that you have unearned service revenue in the T account of $24,000, but the correct balance, at the end of the period is $10,500. Okay, so what are you going to do? Well, you're going to recognize that service revenue because you're holding too much in that liability account. So the difference is $13,500, and you're going to debit the liability, the unearned service revenue account, or by $13,500, and then you're going to credit service revenue for $13,500. Do you get how this works now? I mean, this is something that, it's just logic, but you have to learn the terminology. Okay, supplies. Supplies is your supplies inventory, or it's the asset account. And the T account balance is $8,500. The correct balance is $2,600. What's the difference there? $5,900. And so what you're going to do is you're going to recognize the supplies expense for what you used during the period of $5,900. So your debit entry is going to go to supplies expense, and then your credit entry is going to be a credit entry to the supplies inventory asset account. So supplies are going to be credited by $5,900, which will reduce the asset down to its correct balance of $2,600. And then you've got an interest payable account that's set up for $2,400, but at the end of the period you see that it's $2,000. And so you're going to recognize interest expense of $400 and then reduce interest payable with a debit entry of $400. So I guess what we should say here is that, no, wait a second. Well, I said that wrong. We have interest payable of $2,400, but the correct balance is $2,000. And so what we have here is we're going to debit the liability and we're going to credit interest expense. So what we're doing is we're going to be reducing an expense. This was probably a correcting entry of some sort, but it says we had interest payable of $2,400. We must have paid some interest during the period, but we didn't. Whenever we paid it, we didn't credit the payable account. We must have taken it as an expense again. So we have to correct it by offsetting interest expense with a credit entry of $400. Maybe this is a case where we booked the transaction and we didn't check our chart of accounts carefully enough to see that we had already recognized the interest as having been payable from a prior period. And so when we made that payment to the bank, if we didn't correct it, we would be double counting an expense. So that's what's going on with interest payable. Okay. Your homework grade, I want to say this again. Your homework grade is basically for your effort in doing the work and showing me that you did the work. So those of you who worked really hard and got everything wrong still got 5s. Those of you who didn't work as hard and it was obvious that you didn't and that you could have done more got 4s. I don't think there were any grades lower than a 4. I don't want any of you to get 0s. I want you to do the homework, and if you haven't done it yet and submitted it, I've left the portal open so that you can submit your homework late. So please do so, and if you do so, you won't get a grade lower than a 3. So please submit that homework, and even if you're just copying it down from what we did here today and in the other lectures, make sure you get it submitted. Make sure you do it. You learn by copying it down and by reviewing things. Even if you didn't get it the first time, try it again and do it the right way now that you've seen this video. Thanks a lot and have a great day, and good luck on your midterms. Bye-bye.